All right, guys, welcome back. And today I want to take a moment to compare three investing types to show how much of a difference it can make in your retirement based upon which style you choose. Now, there's many different types of investing. There's many different options. We're going to compare the most popular and basic of the options for the stock market. So we're going to start with index fund investing. All right. Then we're going to go to dividend growth investing, and then we're going to go to income investing. Now, it's important to understand that even inside these genres, there's a whole bunch of different nuances and what people consider what. So what I want to do here is try and get from a tax version, from a safety version, as in not a lot of losses, NAV erosion, and kind of bring to bear the best of the three in order to make it a more even playing field. And there is no right answer. Each one of these are useful in their own way. A combination of these three, I personally think, is the best policy. But let's just talk about raw numbers, because in your part of life, one may be good for you. In your one part of life, one may not. So let's go ahead and start off with index fund investing. I think this is the most popular and the most understood, because most people are just like, okay, we'll put in a target fund or a total market fund, and we'll put in my 401k, my Roth, whatever. And they just bust money in there with the intention of getting enough to be able to take out 4%. Now that 4% has been looked at a million different times, a million different ways. The Trinity study is probably the most popular. That's what made the 4% rule really popular. This study basically says that, over a 20, 30, 40 year period, depending on how you're set up, that pulling out 4%, you shouldn't run out of money. Shouldn't, okay? Nothing's for sure. So in that kind of investing, I need a baseline for all of our comparisons. So what we're going to do is we're going to have the person wanting $40,000 a year. Now, I don't know that in this day and age that 40 grand a year is a lot. I mean, if somebody's getting Social Security as well, yeah, 40 grand's probably going to do you all right. But it is a fact that as we get older, we spend less because we go do less. Now, with the index funds, and I would think most normal people that are looking at it would be looking at something like SPY or VOO, something that has the S&P 500 broke down. You may even go to a more like a total market fund, like a VTI. If you're going mutual fund, FZROX. So basically a large chunk of the market. And then you sock cash in there to build up. Now, if we want $40,000 a year and we're using the 4% rule, it means we need $1 million. All right. And for a lot of people, they feel like $1 million is just unattainable. But it's important to understand that the stock market as a whole, inflation adjusted, usually wants to return somewhere between 7 and 10%. All right, a year. That's an average. Some years you've got 25%. Some years are down and you have losses for the year. But after it all comes out in the wash, you get 7 to 10%. All right. So if we're only pulling 4, over time, our portfolio should grow. And then the 4% should get to be more. So that is one big positive to index fund investing. Now, if we're going to go to dividend growth investing, I have to be very careful here, because some people consider an ETF, a dividend ETF that pays 2%, part of dividend growth investing. Some people may say like a BDC ETF that pays 10% is dividend growth investing. So here's what I want to say. A fund like SCHD produces about 3.5% on the yield, depending upon where it's at any given time. So apples to apples, you could throw some other things off to skew the thing, and I still would need $1 million. But let's say that somebody's trying to look at another option separate from the standard 4% kind of idea. I would think most dividend growth investors have some things like Altria or BDCs or REITs or something else to skew their yield. All right, maybe they have a bunch of SCHD, maybe they got some ETF that does a bunch of BDCs, and it skews their yield. So what I want to do is say that, a 6 to 8% yield is very doable in dividend growth investing. Now, if you were to go all in on, say, a 4% yield, with the lower, safer end, more established companies, maybe don't grow as much, you're going to need $1 million. Whereas if you go to, say, a 6 or an 8% yield, then you could probably go down to $500,000, $600,000 and still get your 40 grand a year. Now, that's a lot less money. That's like literally half, maybe a little more, and a lot more attainable for most people. But what dividend growth investing does is it gives you the mental understanding that you don't have to sell shares. And for a lot of people, they have problems accumulating over that time in index funds and then selling off chunks every year. It just depends on what your mentality is. Now, I do want to say I'm not going to try and get deep in the weed on taxes, but I'm going to give you a light overview as we go and then talk about it at the end a little more. But when you're growing a dividend portfolio, you're paying taxes every year. Now, granted, on a dividend growth, after your first year, most of your stuff's going to be long-term capital gains, so it's not going to be that bad. But I do have to mention that because growing an index fund, other than a very small dividend, you're not paying any tax on that as it grows. So tax efficiency throughout your lifetime, that is definitely a better option. You could also put these in retirement accounts. There's always a way to get around it, but you can see the difference here where we need $1 million here in index funds. Now we're at dividend growth investing, and we could be anywhere from $1 million to $500,000. All right. Now, some people will add higher yielding in to dividend growth investing, but I'm just trying to keep us on a level playing field here. Now, the last one I want to talk to you about is income investing. Now, people are going to go off about this, and I understand. I have a full-blown income portfolio of very risk-adjusted assets that I hold. We are early retired off some of these. So I understand that a lot of people will be like, this is not fair. You need to put some of the high-yield ones in. I'm trying to make this as balanced as possible from tax efficiency, from, share price holding up. So on the third one, on the dividend income investing, where you're getting distributions or getting high yields, we're going to try and stay above 12%. And most people will be like, 12% a year is insane. What are you talking about? So most of these are going to come from things like covered calls, closed-end funds, very risk-on, ideas and options for making money. Now, a covered call fund is probably the one most people are going to understand. I want to use SPYI as an example with a 12.2, 12.4% yield. All right. Just that fund alone has proven with its track record, which granted, it hasn't been out that long, but it's proven that it can weather markets and hold up. And it has proven that it can pay that yield. It is not hard for a covered call fund to produce 12% on the S&P 500. So I think it's a very safe, adjusted option. And a lot of people would say the taxes are really bad on a lot of those funds. And you'd be right, except when you're dealing with something that's selling on the index. Because when you do index options, you get a better tax treatment. So when SPYI pays out, you get a 60-40 split. 60% long-term capital gains, 40% short-term. And you do not have to wait the year to get the long-term. But that's saying nothing because last year, 85 to 90% was return of capital. So if we're going off those numbers, you're essentially not going to pay any taxes for the first 10 to 12 years if they keep doing that. And after that, it's going to be a 60-40 split. 60% long-term, 40% short-term. So on taxation, it's really close, guys. It really is close. So we can take taxes and throw them out the window on that one. Now, 12% means you only need 1/3 of that $1 million. All right? So I would say $350,000 would probably do it. You could say 400,000 if you wanted to be careful. It depends on what you get the share price at. If you're buying it on a dip, 350,000 probably is plenty. Now, if you wanted to go the extra step and say, but taxes, Tony, taxes. They've got a QQQI fund, which has been putting out over 14% for quite a while now. Invest in that fund, it gets the same preferential tax treatment, and you can take your 12% and have the extra 2% to cover taxes. So there's your way just to offset the whole tax purpose of the whole thing. All right? There's money there to pay those taxes. So, $1 million for index funds. In the scenario I built, obviously others could do better. You've got 500, 600,000 for dividend growth investing. Income investing, you're not going to have a whole ton of share price appreciation. You need to understand that. That's where it differs from the other two. But you need 1/3 the amount. So say $350,000 to get the same 40,000 that you need $1 million for over here. I think when you look at the three investment types, there's pros and cons of all of them. You know, you're going to get a lot of growth here in index. You're going to get a little bit of growth here in the dividend growth investing. And you're going to get very little, if any, growth here in the income investing. Now, what I want to talk about first is when these funds and these setups get out of control. All right. And what I mean by that is, as like a standard married couple, if you're making, say, $150,000 a year, $200,000 a year, you're going to want to be in index funds if you want to be the most tax treatment preferential. The other two are not going to do too well once you get above that point. Now, obviously, I know a lot of people aren't planning to make $200,000 in retirement, but it should be noted. Now, for our personal situation, all right, we have index funds. In fact, in our retirement accounts, we sell options in our traditional and put it in index funds and are letting them age. So they're a year, when they come out, they'll be taxed at long-term capital gains. So we use index funds. Dividend growth. We use some dividend growth to give us a bump in our early investing days. And we realized that taxation was a thing. So what we've done, because we wanted to get retired as fast as possible, is we move those funds into income. All right. We have funds that honestly have already paid all their money back. So you could call them within a year almost 100%. So 100% yield. Now, you're going to get NAV erosion with that. You're going to get a lower share price. But we take all of our assets and we buy safer assets. In fact, at the moment speaking, I'm not just telling you guys what things pay. I'm buying them because we are actively filling our account up with QQQI right now. Also things like XDTE, things like SPYI. Adding these in to make safer funds. But the point I'm trying to make is time is the one equalizer of all these. Do the one that you have the time to do. Do the one that's going to get you to where you want to be in the amount of time you need. There is no one size fits all here, guys. A lot of people say, keep it simple, invest in index funds. If you've got the timeline to do that, please do that. That is a very efficient way. Some people say, I have a little less time and you want to do dividend growth. And it feels good for you to have money going in there every month or quarter. That's going to make you feel good, make you put more in. Do that. Please do that. Don't worry about the taxes. If you stay keeps you motivated, do it. These are blue chip companies. If that makes you feel good, do it. If you're out of time, if you want to get to retirement as fast as possible, if you are a very, very low earner and can't seem to create more capital and you're willing to deal with the taxes, then I would encourage you to look at income and fund investing. You know, income is not a bad word. And everybody says these income funds can't sustainably generate this kind of capital. And I would say to that, look at JEPI, look at JEPQ, look at Devo. These are long track record. and they've just been producing cash for a long time. Everybody's going to have their own way of doing these things. If you have an opportunity to have an account with some index funds, please do it. Please do it. You will be glad you did. Even if you don't use it right now, it'll be a backup plan. Always have a backup plan. But for us, in our situation, and I don't want anyone to copy us, this is not financial advice, but the income fund investing bought us our time back. With that time and some of the money we're making from our index, we are investing into more index funds. Some of our income funds are paying to make an index fund account. So I take capital from the income funds and put them in the index funds. Just a share while we're living off the rest. I am 47 years old and I am financially independent. I have never made a bunch of money in my life. We as a couple started late in life and we made it through, and so can you. So pick your poison, whichever one you want. Just make sure you're getting out there and investing. And I will see you in the next one.